All right, let's talk about STGI Industrial. For a lot of investors, it's that reliable cornerstone for monthly income. But a pretty compelling research report makes the case that it's a textbook value trap. So today, we're going to break down that exact argument, really get into the anatomy of what could be a trap for income-focused investors.
For years, the bull case has been incredibly simple and, frankly, very appealing. You get to own a piece of the American supply chain, hundreds of warehouses. You collect a steady check every month, and you sleep well at night. It's a story that just makes sense, especially in a world that's been desperate for yield. But here's the pivot, and this is the absolute core of the argument we're digging into today. That simple, safe story, well, the claim is that it's built on a bedrock of assumptions that just aren't true anymore. The very foundation has fractured, and we're about to examine every single crack.
So first things first, we have to understand why that old story is broken. The macroeconomic world that lets STAG thrive is, well, it's over. And that makes looking at the last 10 years a really dangerous guide for what's coming next.
This brings us right to that massive macro shift. We're talking about some powerful tailwinds that have completely reversed and are now blowing straight into the company's face as headwinds. Let's break down the first big one.
Okay, so first up, demand. Remember the post-pandemic craziness? It created what's called a just-in-case inventory supercycle. Companies were so terrified of running out of stuff, they leased pretty much any warehouse space they could get their hands on. It was a rising tide that lifted all boats, regardless of quality. Well, now, that cycle is over. It's completely unwound. Leading indicators like less-than-truckload freight tonnage are pointing down. Logistics managers are getting lean again, and that frantic demand for just any old space, it's gone. Second, and you could argue this is the most important piece of the puzzle, is the cost of capital. For about a decade, STAG was playing in a ZIRP world, zero interest rate policy. Think about it. They could buy properties that yielded 6 or 7% while borrowing money at 3 or 4%. That positive spread, that was their growth engine. Now, we're in a higher-for-longer reality. Their cost of capital has shot up, and making acquisitions that actually add to earnings per share, well, the math just doesn't work anymore. The engine is stalled out.
And the third major headwind is supply. You see, back in the zero era, construction was pretty disciplined. But the boom times of 2022, that kicked off a tidal wave of new development. And all that new supply is now hitting the market, right in STG's backyard, in their core secondary markets. This means they're facing a glut of brand new, modern buildings that are competing directly with their older, less functional properties.
So, with those huge macro headwinds as the backdrop, let's turn inward and look at the business model itself. This is what the report calls the aggregator's dilemma. The argument is that the strategy has some deep intrinsic flaws that are now getting painfully exposed.
So the first flaw is baked right into the kinds of buildings they buy. STAG's whole focus is on single-tenant properties, and that creates something called binary vacancy risk. It's pretty simple, actually. Unlike a big office building with lots of tenants, a STAG property is either 100% full or it's 100% empty. There is absolutely no in-between.
And when one of those properties goes dark, man, the costs are just punitive. It's not just that the rent check stops coming in. No, as you can see here, the landlord, STAG, immediately starts bleeding cash on things like taxes, insurance, and utilities. Then finding a new tenant in these secondary markets can take 1, maybe even 2 years. And then you get hit with a multi-million-dollar CapEx bill just to get the space ready for the next guy. These are the hidden costs of the model that often get overlooked.
This leads to a really crucial concept, and I love this analogy: the fortress versus the cornfield. Think about it. STAG's peers, like Rexford, operate in coastal fortresses like Southern California, where land is incredibly scarce. That gives them enormous pricing power. STAG, on the other hand, operates in cornfields, secondary markets where there's plenty of cheap land. So if they try to push rents too high, what happens? A developer just buys the field next door and builds a brand new competing warehouse. This effectively caps their rent growth forever at whatever it costs to build new.
So you put all of these factors together, and what you get is the commodity trap. They don't have a real competitive moat. Their rents are capped, they have an aging portfolio that's becoming obsolete, and all of this means they end up attracting tenants who are often in lower margin, higher risk businesses, the ones who can't afford the top-tier spaces. It's a tough spot to be in.
Okay, so how does all of this structural weakness actually show up in the financials? Let's dive into the capital allocation and the valuation, because this is where the pieces really come together to make the case for STAG as a classic yield trap. And let's be really clear here, STAG's success over the last decade wasn't really about being brilliant operators. It was about financial arbitrage. They were a spread investing machine, and that machine is now broken.
And this chart just lays out the collapse perfectly. Back in the day, in the Zerop era, STAG was enjoying this fat 320 basis point spread between what they paid for buildings and what it cost them to get capital. Today, that spread has been crushed down to basically zero, if not negative. The engine that drove their external growth has just seized up completely. Now that famous dividend that everybody loves, in this new world, it actually starts to look more like a liability. As this chart shows, they're paying out so much of their cash flow that after you account for the money they have to spend just to maintain their properties, there's very little left over. That means they're constantly dependent on the capital markets for money to grow or pay down debt. And that's a really tough spot to be in when capital isn't cheap anymore.
Okay, let's talk valuation. Right now, if you look at STAG's stock price, the public market is basically pricing their entire portfolio at an implied cap rate of about 5.8%. Now, just lock that number in your head for a second, because it's the key to this whole thing.
So, we have to ask the critical question, right? Forget the stock market for a second. In the real world, where actual buildings are bought and sold, what are sophisticated private equity buyers demanding for older Class B warehouses in secondary markets, especially now that they can get over 5% completely risk-free from the government?
This table makes the valuation argument really clear. Sure, on the surface, STAG trades at a discount to a premium peer like Rexford. But the whole point of the report is that this discount is nowhere near big enough to make up for the massive difference in quality, in rent growth potential, and in liquidity. A 15 times multiple for low-growth, high-risk cash flows can actually be way more expensive than a 20 times multiple for high-growth, fortress-like cash flows.
So the conclusion here is pretty unavoidable. Private market buyers, the real pros, they're demanding cap rates of 6.5%, maybe even 7.5% for these kinds of assets. The public market's 5.8% valuation, it means the stock is trading at a significant premium to what the underlying assets are actually worth.
So to synthesize it all, STAG is facing this perfect storm of risks, all hitting them at the same time. You've got macro risk, market risk, a broken business model, and fundamental asset risk. It's a tough combination.
When you put all the evidence together, STAG really seems to fit the definition of a yield trap perfectly. The dividend looks attractive, sure, but it could be masking a slow and steady erosion of the portfolio's real economic value. That value is getting eaten away by inflation, by obsolescence, and by that fundamental lack of pricing power.
And the source material really offers this powerful guiding principle. In the world of real estate, long-term value isn't created by just buying up a bunch of commodity assets. It's created by owning and controlling scarce, irreplaceable ones.
And this really leaves us with the final question, the one that any investor in this space has to answer for themselves. In a world full of uncertainty, where should your capital go? Should it flow towards the scarcity and pricing power of a fortress, or toward the easy, but perhaps illusory, yield of a commodity? That's the core dilemma right there.